Sounds like gold. They are buying these stocks in the expectation that someone will be willing to pay a higher price later.
Greater fool is someone with the perfect blend of self-delusion and ego to think that he can succeed where others have failed.
So, greater fool theory, believing you can succeed where others have failed. Basically, the recommendations in this book are called market timing, predicting what's going to happen over the next 2 or 3 or 4 years. You know, it's hard to get prognosticators to give you the exact date of the next crash. That would be helpful, by the way. But if you did have that information, it would be nice to have in the book. But yet, telling people that no matter what happens, my mix of assets, my stocks that I'm picking out, my gold that I'm picking out, my long bonds and currencies that I'm picking out, those are the right ones. And everybody else is messed up on their valuations. He goes on, dividend-paying stocks, on the other hand, are real investments because they pay you to own them. So let me get this straight. Gold is a real investment because it's not paper money. But if you're going to own paper money, then you need to own dividend-paying stocks. You know, it's interesting that these dividend-paying stocks just happen to be the things that were hot over the last 5 years. Hindsight biased? You judge. This makes your portfolio grow even if the share price stays flat. Not really, because as soon as they pay the dividend, it goes down. Now, have you been hearing people, I mean, this whole dividend thing, invest in dividend-paying stocks, that's the newest, hottest thing that you're hearing about out there, whether it's Kramer or Susie Orman or Peter. You hearing much of this from investors out there in the real world?
I mean, you hear it often. They think if you're going to have income from your portfolio, that's the only way you can get it is from dividends. And that, you know, they hear it from people like Peter Schiff, I suppose.
I'm sure they do. I mean, it is rampant. I mean, it's not just, you know, Peter saying it. It is many people in the media who are out there saying you need to own dividend-paying stocks. Many people who have big names like Susie Orman and who's the guy with the envelope system, Dave Ramsey. Dave Ramsey says the same thing. I mean, all these big names are telling people, and they have big followings, are telling people that you should own dividend-paying stocks, and that's how you get your income from your portfolio, and they're safer, and all these different things. But and you can see why people really latch onto that, and how you have to have conversations talking to people about how dividends really work with regard to stocks, and how, you know, the total return is the same. It doesn't matter.
So Dan, we've done a lot of white papers on this, and I know you've done a lot of research about high dividend-paying stocks. What say you on this issue?
As a sidebar, I mean, you got to look at the tax consequence too. I mean, yeah, you're getting a dividend right now. You're paying tax on it right away, as opposed to prolonging that down the future. And come a year end, who knows what Congress does if they pass something, but what are these guys going to say then when you're going to be paying 43% tax on a dividend?
Yeah, so you pay out a dividend, your stock goes down by the exact return of the dividend, and then you lose 40% of your money. That's a great strategy. On bonds, he says, if you buy one, make sure it does not hedge to the US dollar, that it owns the right currencies, and that its portfolio has a short duration. We can agree with the short duration, but who exactly knows which currency is going to take off next? I guess it would be Peter. As far as I'm concerned, betting on the dollar getting down now is easier betting than housing again in 2006. He says, I'm always looking for foreign currencies to hold, not for the sake of currency speculation. I paused there for a purpose, but for a relatively safe liquid store of wealth. If you are gambling with currencies getting in and out of countries, you are not reducing risk, you are increasing risk in your portfolio. The expected return of currencies is 0 over time. Anyone that could predict on a day-to-day basis or a month-to-month basis which currency was going to go up or down, they wouldn't tell you in a book. They'd be speculating with currencies, leveraging it up, making 40–50% a year. Come on. On gold, he says, over the past decade, gold has outperformed any stock market. And he goes on to say gold 19.81, January 2002, December 2011.
That's annualized.
That's annualized, 19.8% per year.
Pretty good run.
Which is, yeah, that's really great. But shall we go back to the statement? Over the past decade, gold has outperformed any stock market. Any stock market. Maybe we should look at a couple different stock markets. For example, Indonesia is up 33% per year over the last 10 years. I wonder how many of those are dividend-paying stocks. If we look at Thailand, Thailand's nice because that's 22.6% per year, a little bit higher. Let's go on, shall we? Brazil, 21.58% per year, a little higher. Colombia, 37.9% per year. Let's just round that up, shall we, to 38? Now, Peter says he believes in international stocks. Shouldn't he have known about this?
I would think so.
Where, you know, and by the way, none of these are companies, or countries rather, that he actually recommended as the preferred countries to own. Peru, 30%. Little Peru, 30%. There you go. And how about Czech Republic, 25%. Egypt, whoops, let's go back, 23%. So I think we can say that, no, you need to do a little bit more research on this one. And if you're trying to predict markets, trying to predict when gold's going to be great or high dividend paying stocks are going to be great, you're going to miss amazing opportunities like this because you're not going to be globally diversified in all the markets because you're trying to get in and out and predict which countries or which currencies are going to be the best. But he goes on to say, sure, if someone was dumb enough to buy all their gold in 1980 and then hold it through a 20-year bear market as the Dow Jones rose 711,000, they deserve to lose their money. Okay, there's a problem with this. This is a little something that academics call hindsight biased. You don't get to know Peter, nor does anybody at Merrill Lynch or E.F. Hutton. E.F. Hutton's probably not even around. Those are people, when E.F. Hutton talks, we listen.
I forgot to listen.
They're gone. Bear Stearns, gone. Nobody gets to know in advance what the market's going to do precisely over the next 10 years. You don't get to know if the Dow's going to do this or if gold's going to triple. You don't get to know in advance. That's why you diversify. That's why you build risk reduction into your portfolio.
A 12,000 leg stool.
Huh? It's a 12,000, yeah. See, if you have 12,000 stocks in 45 different countries, that's a much more stable stool, especially when 3 of your stool legs are broken.
I think it's a different type of stool.
It's a different kind of stool. We just went to a really ugly place. But it's not fair to blame their losses on gold, he says. It wasn't gold that was to blame. It was just that you shouldn't be in gold when it doesn't do good.
Right.
You should only be in gold when it does really good.
It's the people who bought its fault.
It's the dumb people.
Yeah.
It's the dumb
The dumb people.